You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. Well, let's start by looking at a trade. We did a trade last week. It was a diagonal in Pepsi, and that trade, based off of the expirations, is still alive if you were doing it on paper. And I just want to comment on it real quick. If you want more detail, we gave a lot of detail last week on Options Playbook Radio. And as always, we always like to say that these are meant to be done on paper. We're just trying to learn here on Options Playbook Radio. And our main goal is to look for scenarios that plays inside the playbook might fit. It's never based off of a forecast on the underlying. We're just saying we're looking more at how the volatility is working, where they're at expiration. And specifically, this allows us to do a lot of trades around earnings because there are interesting scenarios that happen around earnings as far as the option pricing is concerned. So last week, we went and we looked at Pepsi, and we did a diagonal in Pepsi. Pepsi last week was at 113.05. We sold the February 15th expiration, and so that was a week ago from today. And then we bought the February 22nd expiration. Now, Pepsi's announcing earnings on the morning of the 15th, so a very interesting trade. We did this specifically, mainly because not because Pepsi is Pepsi and we have a view on the earnings. It's mainly because they are actually going to announce on February 15th, and that means there's only 1 day for that option contract to live. So we looked at the expected move. We went out about 3 points. We sold the 116 call that is now going to have basically 1 day to live. And then we bought the February 22nd call, the 117 call. We did this for a net credit of 10 cents to the account. So an update. Pepsi has gone up $1 since then. Well, $1.07 to be more exact. Right now that trade is looking like a net credit of 13 cents to the account, with the market gone up $1. And I find that interesting because that's exactly what the net delta was. So the delta actually gave us really good insight into how this trade was going to react. We had a 4-cent net delta, and guess what? We're down 4 cents on this trade. Using the midpoints right now, if we would have executed last week at 10 cents, we could close it right now for a 13-cent net debit. But if you'd put it on last week, we even mentioned we'd probably wait until the day before and do the trade. So I wanted to do an adjustment. The market's up 1. All we would do is adjust the strikes $1. So we would look at selling the 117, buying the 118. We're looking at the February 15th expiration is the one that we'd be selling. Once again, we'd be buying the February 22nd expiration. Today, right now, we're taping Options Playbook Radio. It is the 13th of February. The markets are closed. So you'd be looking to do this tomorrow. Want to look at the quotes on the open, see where it's at, and then try to go basically 3 points up on the strike is what we'd be looking to sell, looking for calls, of course. And that trade is done for a net credit of 6 cents. So a little bit less of a credit, but still getting it done for a credit. And that's the main goal here. Okay, so that's an update on the Pepsi trade. Now let's look at this week's trade. We have a fun stock that is going to be announcing earnings. And this is part of the reason why I don't mind doing these on papers, because it has really been a mover lately. NVDA Corporation, symbol NVD as in dog, A as in apple. NVIDIA, NVDA is a symbol. They are going to be announcing this week also. They're going to be on the close on the 14th. So I've talked about a lot of skip strike butterflies, and every once in a while I kind of forget about the old Christmas tree butterfly. So we're going to look at a modification on a Christmas tree butterfly. You can find that in the options playbook. There are Christmas tree butterflies. It's more so just, it's odd because you're going to be doing, instead of a 1:2:1 ratio, which is just a standard butterfly, we're going to do a 1:3:2. So we're going to buy an option contract, sell 3 option contracts, and then buy 2 option contracts. In this scenario, we're going to set it up where the strikes are equidistant, and our whole goal is to get the trade done for, once again, a net credit, much like the skip strike butterfly. This allows us to be wrong on our outlook for the underlying stock and still be some sort of profitable on the trade, depending on the amount of the net credit. Now, some of the benefits of doing it as a ratio, 1:3:2, is still going to be limited risk. As long as the number of option contracts you buy add to the middle, you're going to have limited risk. So we are buying 1, selling 3, buying 2. 1 + 2 = 3. So that means overall we're not going to have any exposure on an unlimited basis. Now, we will have a little bit of risk, because here's the concept of it. When we go 1:3:2, we are actually selling an extra credit spread. We're buying 1 long spread, which that's going to be our workhorse if we're correct on our forecast. And then we're going to sell 2 short call spreads. One of those short call spreads we're hoping will pay for the debit spread. And that's going to be the scenario here. Hence, we can do the butterfly for a net credit to the account overall. But since we're selling 1 extra call spread in this scenario, we are going to have a margin requirement. We're going to have some risk on this trade. And that risk is that $2.50, basically the width of the strikes. Okay. So we have a margin requirement, but we're going to get this entire trade done for a net credit to the account. So let's get into the trade. So we're going to go to the nearest expiration. We want these contracts to go away in a hurry if we are incorrect and the market goes the opposite direction. We're going to be bullish on this, and that's part of the reason we've always usually leaned bullish, because we really don't have an opinion on what's going to happen to the stock afterwards. But if markets go up, implied volatilities have a tendency to go down faster on the upside. And just overall, if markets go down, they have a tendency to go down faster than they usually go up. That's just kind of more of a gut feeling than anything. But in this position, the one thing that we don't want is a big move. We do not want it to move more than the expected move. We don't want it to take off on us. So we're doing the February 15th expiration. Stock right now is at $152.88. The stock was up $1.71. The markets are closed. It is February 13th, a Wednesday. If we did this trade right now, we'd first want to look at the long straddle, what the marketplace is thinking the market might actually do in this instance. And here our long straddle is trading for $10.75 at the midpoint. That means if we bought the 152.50 put and bought the 152.50 call, the most at the money options, The total cost of that trade would be $10.75. That's about the expected move. We want to be a little bit further out of there. Out of that range. We're going to be on the bull side. So we're going to go out and buy that February 15th expiration for all these option contracts. We're going to buy the 165 call, sell 3 of the 167.50 calls, and buy 2 of the 170 calls. Net credit at the midpoint to the account, if we execute that trade, is 20 cents. We have a $2.50 wide spread. So that is our risk, because that's the extra credit spread that we're selling here. So the risk is $2.50, but we received a credit. So the total risk would be $2.30, because we can use that credit to offset any losses that we may have. And if we do this trade, we want the market ideally to announce earnings on the 14th after the close, and the market moves up. Basically, the expected move, $10.75, and then trickles a little bit more north, and it slowly reaches our 167 strike right at the expiration date. And that would be our best case scenario. That means if it went out right at 167.50, we would make $2.50. That's what the width of the spread is, plus the 20 cents, or $2.70 on this trade. If the market does nothing or goes down, well, we're looking to score a net credit of 20 cents to the account. All the options would expire worthless, and that would be our gain if we were dead wrong on the forecast and the market went down or stayed exactly the same. Where our max loss occurs is above 170. So think of this. Our expected move is $10.75. The market right now, we're going to call it 152.50. It's very close to that. So 152.50 minus 170, we're talking about a 17.5 point move. And that's on one day. So in order for us to lose this maximum, we got to go almost double what the expected move is. So we need a very big move. And really, that has to be on the gap on the opening. Now, could a stock like NVIDIA do that? Yeah, without a doubt. So they announce earnings afterwards, and could it make that move? It is possible, but it's still a very big move. If it does not do it on the gap opening, right? If it doesn't gap open over 17 points, well, that'll allow us to trade out of it. And that's really ideally what we'd like. We'd like it to open 5, 6, 7, 8, 9 points to the upside and slowly drift towards the strikes inside our butterfly. All right, so that's it. 2 trades to watch this Friday. We're going to look at the Pepsi trade, and if you are doing it on paper, I would adjust it right now and just look at moving up a little bit, move up 1 point, because Pepsi's basically moved 1 point on both of the strikes. And then on the NVIDIA Corporation, we got a fun alternative to the skip strike butterfly. It's basically, well, you call it a modified butterfly, but in the playbook, the one that it looks the most like is the Christmas tree butterfly. That's it for this episode of Options Playbook Radio. If you have a topic you'd like to discuss on the show or a question you'd like us to answer in the program, please send them directly to me at theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.